After this emergency takeover of Credit Suisse, lots of people are worried about the current health of our banking sector, especially considering that tomorrow, March 22nd, the Federal Reserve Bank is going to announce their newest interest rate hike or interest rate pause, or I guess potentially even an interest rate cut. And depending on what they do, it is going to put a big influence on the banking sector and our economy. So let me start by talking about what just happened with Credit Suisse, because UBS just bought Credit Suisse in a fire sale and an emergency takeover because Credit Suisse was on the verge of collapse. And I'm going to give you a little timeline of what happened over the last week. On March 15th, 2022, Credit Suisse's financial issues were coming out, and the CEO said that a bailout is not an option, that the company and the bank is still strong. That was Wednesday. On Thursday, March 16th, Credit Suisse took out an emergency $54 billion loan from the Swiss Central Bank. That way they could stay afloat. And then they said that now they have the reserves to continue operating and running like normal. But depositors, people that saved their money in the bank, kept pulling out billions of dollars. Then Friday, the next day, March 17th, that's when rumors started coming out that UBS was in talks to buy Credit Suisse. On Saturday, March 16th, it became public that UBS offered a $1 billion price to purchase Credit Suisse, which Credit Suisse rejected. They said that that $1 billion offer was way too low. The Credit Suisse's buildings that they own are worth more than $1 billion themselves, so they wouldn't accept that price. But by Sunday, Credit Suisse was running out of options, and Credit Suisse accepted a $3.2 billion purchase price to sell their company to UBS, which meant that billions of dollars worth of investments and loans to the Credit Suisse bank itself were now gone. The depositors were safe, at least they're safe for now with the new UBS purchase, but the people that were owning the Credit Suisse bank lost a huge chunk of their market value, and the people that lent money to the Credit Suisse bank itself also lost a lot of value. There's something like $17 billion worth of loans that are now completely wiped out. These are investors who loaned money to Credit Suisse in the form of bonds over whatever course of time, but about $17 billion worth of investments into the Credit Suisse are now gone. Now, what caused all these major issues to happen? Well, we've been covering this on this channel and on market briefs, but the big thing was frauds and people pulling their money out of Credit Suisse. In the last quarter of 2022, about $157 billion were pulled out of the bank and taken elsewhere. Why? Because Credit Suisse has been dealing with fraud after fraud after fraud, and that came with a lot of penalties as well that they had to pay. And then on top of that, we just had the Silicon Valley Bank collapse. When that happened, a lot of people were naturally worried about the banking sector, so people wanted to pull their money out of potentially risky banks. And so people were pulling the money out of Credit Suisse, and then not too long ago, in the last couple of weeks, Credit Suisse released their financial statements for 2022, and they said that there's material weakness in their financial reporting, and that's what just caused a huge spiral for Credit Suisse. If you haven't joined Market Briefs yet, it's a free way, it's a free newsletter to keep you up to date on what's happening in the financial news. And we just created a new banking section that every day in our newsletter, you'll get an update as well of what's happening in the banking sector. So we covered Credit Suisse, we covered the Swiss National Bank, what they're doing. We covered the Silicon Valley Bank. I mean, we've been covering everything in the banking sector. So if you want to stay up to date on what's happening, join Market Briefs. It's completely free. And I got the link for you down in the description below. But this is where now understanding what is the implication of Credit Suisse on our economy here, because it does affect investors here, because obviously some investors were invested into Credit Suisse, but then you also have banks here in the United States that have exposure to Credit Suisse who probably lost a lot of value. We don't know that total amount yet. The Treasury Secretary Janet Yellen has opened up an investigation to see how much exposure US banks here in America had to Credit Suisse, and now that this takeover has happened, well, they probably lost value on that. And so we don't know the total extent of that just yet. But the big thing that you want to pay attention to is going to be tomorrow. Because tomorrow, Jerome Powell, who is the chairman of the Federal Reserve Bank, is going to announce what he wants to do with interest rates. Now, let's kind of put this all together. So we have high inflation still. Inflation is still not coming down to where the Federal Reserve Bank wants it to be. Just a few weeks ago, the Federal Reserve Bank was meeting with Congress saying that they need to be more aggressive to bring inflation down. How did they become more aggressive? By raising interest rates more aggressively. So that's what Jerome Powell was saying just a couple weeks ago. Between that time and now, we have seen Silicon Valley Bank collapse. We saw Signature Bank collapse. We saw Credit Suisse with this fire sale. And we have a lot of smaller banks here that are still struggling, that have gone through a lot in the past number of weeks. And now tomorrow, Jerome Powell is going to announce what he wants to do with interest rate hikes. And originally, let's say before Silicon Valley Bank collapsed, the consensus was that they were going to raise interest rates by around 0.5%, 0.5%, which is more aggressive than they have been recently. Now you have this big debate whether they're going to raise interest rates at all. You have some people like Goldman Sachs saying that the Fed is not going to raise interest rates. They're going to put a pause. And then you have other people, other economists, saying that they're going to go less aggressively with a 0.25% interest rate hike. How far will they go? Well, I'm not going to go too deep into that, but let's see what they do tomorrow, because that's going to give us a big indication over what's going to happen, because higher interest rates put more pressure, not just on banks, but on the entire economy. It puts more pressure on businesses, it puts more pressure on a national government, and it puts more pressure on people because borrowing costs go up. So let's see what the Federal Reserve Bank does. But then, back to the banking sector, recently our Treasury Secretary Janet Yellen gave a talk about your deposits and how safe they are. And essentially what she said is that our banking sector here in the United States is safe. And what the Treasury with the FDIC did after the Silicon Valley Bank failure was they said that if you had money in a bank, even if it was beyond FDIC, and the bank failed, you could get all of your money back. So what that meant is that FDIC insurance protects your deposits up to $250,000. So if you deposited $200,000 in the bank and the bank collapsed, you would get your money back because of FDIC insurance. But if you had $2 million in the bank and the bank collapsed, you would get $250,000 back with FDIC insurance and nothing else. The rest of the money is gone because you saved your money into a bank that failed. But then after the Silicon Valley Bank failed, the FDIC worked with the Treasury Department and the Fed to essentially guarantee 100% of deposits. So whether you had $2 million or $200 million, it didn't matter, you would get all the money back. Well, in the last few days, Treasury Secretary Janet Yellen was asked about this 100% insurance and how long would this last and what does this really mean? And what she said was essentially that they cannot guarantee this 100% FDIC insurance into the future. She said that if future banks fail, that FDIC cannot guarantee that you're going to get all of your money back above FDIC. So the $250,000 FDIC insurance is still there, but that unlimited FDIC insurance is not guaranteed. Let me read you a quote from what she said. She said that uninsured deposits would only be covered in the event that, quote, a failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences. So essentially what she's saying is that they will only insure you above FDIC insurance if the bank failure would cause some sort of systemic risk. What does that mean? Now, we can theorize, and I'm going to give you kind of maybe my interpretation, but this is what they said. We don't know exactly what that means, but what it could potentially mean is if the bank is small enough that it wouldn't create that big of a deal, that they're not going to insure you because it doesn't create systemic risk and it doesn't create, like what she said, quote, significant economic and financial consequences. So if it's a small enough bank, you might have, let's just say, a couple $1 million there. You made some money, you saved up for retirement, or you sold a business and you have a couple $1 million in this small bank. The bank fails and it's not big enough to cause some sort of ripple effect or systemic failure. They will not insure you. But if the bank is really big, they will insure you because that would cause systemic risk, significant economic and financial consequences. That's what it sounds like to me, which kind of seems strange because now it's almost like encouraging people to move out of regional banks and move into the bigger banks, because if you're only going to insure the deposits if it causes the systemic risk and and significant economic and financial consequences, doesn't that seem like you're favoring some banks over the other? Which is where now, the government, along with the FDIC, along with the Fed, want to protect the regional banks, because after the whole banking failure started with Silicon Valley Bank, a lot of money has been moving out of the smaller regional banks. And the Fed has been doing whatever they can to keep the smaller banks afloat and solvent and strong. They created a lending program where smaller banks could borrow money from the Federal Reserve Bank. That way they can have extra cash to stay afloat. But with this statement by the Treasury Secretary, it's kind of interesting to kind of see that dynamic. And again, I don't know exactly what they mean by that. Will they hold true with this? I don't know. Just giving you my interpretation based off of the words that she said. So, take it with a grain of salt and do your own analysis. But this is where tomorrow we're going to hear from the Federal Reserve Bank, and that is going to put a lot of direction on where the economy is going to go, where the banking sector is going to go, and where money might be going to. So stay tuned, and if you haven't already, join Market Briefs, because we're going to be keeping you updated when things are happening.